Hello traders! In this video, we are going to cover the Forex trading terminology. Here you can see the terms that we are going to go through. We know that the most of you know these terms, but it is never a wrong thing to refresh your memory on the basics. Also, as we slowly progress to more complex things, these terms will come back more and more often. So if you cannot remember anything, you can just quickly jump back to this video. Forex stands for foreign exchange. That's where shortcut it came from. It is an international trading system for the exchange of the major and minor currencies. Forex exchange is decentralized over-the-counter market. This market determines foreign exchange rates for every currency. It includes all aspects of buying, selling, and exchanging currencies at current or determined prices. When we are trading Forex, we are talking about going long and going short. Going long means that you are speculating on the price to rise. Opposite of that is that's going short, which is speculating on lower prices. Margin is the amount of funds needed to participate in the market. Trading on margin with leverage is a process in which a broker allows a trader to borrow money and to make a purchase of a particular instrument. Margin is the difference between the amount provided to the trader and the real value of the investment. Let's take a look at a practical example on the platform. When we open one lot of euro-dollar pair, the margin is what we have to hold on the trading account. For this example, it is $1,000. If our position would get to 1,000 loss, you would receive a margin call. The margin call is when money must be added to a margin account after a trading loss in order to meet minimum capital requirements. In finance, the notion of hedging means creating a position in a particular market to minimize risk from another position. Forex hedging simply means opening counter-side position. So, for example, if you are in long on euro-dollar with some bigger target, but you think that price will reverse and go down for the next few minutes or hours, you can open a short position that will benefit from the down movement. There are many different tools through which you can hedge, such as insurance contracts, forwards, swaps, options, many different over-the-counter derivatives, and arguably the most popular are futures contracts. Futures exchanges arose in 18th century to allow transparent, standardized, and effective hedging against the movement of prices of agricultural commodities. The principle of leverage is the use of a small amount of equity supplemented by substantially larger amount of foreign capital to finance the investment. This practice can magnify profits but also losses. Leverage is therefore a tool that increases the size of maximum position that you can open as a trader. For a better understanding, let's give an example. Suppose the trader has a balance of the $1,000 in his account and his broker provides leverage of 1 to 500. In this case, the trader can open a position that equals 5 lots if the account is in United States dollar currency. In other words, $1,000 times 500 would be equal to maximum size of $500,000 per position. In this case, the trader can trade orders 500 times greater than they deposit. And this is the basic pillar of understanding leverage. In this case, if leverage 1 to 500 is utilized, the trader would earn $500 instead of $1 for the same investment. Of course, it is important to emphasize that losses can be equally rapid. Currency pairs are increasing or decreasing by the value traditionally measured in the called pips, points in percentage. Pip is defined as a percentage of 1% of 0.01%. Traditionally, Forex prices have been quoted in a certain number of decimal places, more often to 4 decimal places. And initially, the pip was moving by 1 point in the last decimal place. Most brokers now dimensions Forex instrument in 1 extra decimal place, which means that pip is no longer the last decimal place. The exception you will notice include currency pairs with a Japanese yen. For these pairs, 1 pip value is the second decimal place, while most lit prices has 3 decimals. We will give you an example. Let's say you buy a currency pair euro-dollar for 1 point of 11510, and later you close your position at 1.11520. The difference between the two prices in 1.11510 minus 1.11520. That equals 0.00010. In other words, the difference is just 1 pip, or in other words, 10 pipettes. That is the smallest measurement you can use. The bid represents the price of demand. In other words, it is the price for which the contract can be sold at a given moment. Ask represents the price of the offer, the best price at which the contract can be purchased at the moment. Retail trader therefore always gets a less advantageous price. Spreads is the difference between supply and demand. It is therefore the difference between the bid and ask price. The spread is the expense that a trader must take into account while trading. The absolute necessity for every trader is so-called trading strategy. Each trader has its own financial objectives and acceptable level of risk, which influence use of choice of the financial instrument that he or she buys or sells, as well as the settings of input and output limits, profit with stop loss, and analysis of possible market direction. Because we all have different goals and personalities, the trading strategy always differs. All these factors combined set a specific trading strategy and give a trader the edge. Edge is an important part of any trading strategy. Having an edge means that you have a positive expectancy of an outcome over a certain period. That, for example, means that over 50 trades, you have higher chance to come out of with profit. If a trader does not have the edge, then he or she hardly achieves favorable result in his or her trading. Volatility indicates the fluctuations in the value of an asset of its rate of return over a given period of time and expenses the risk of investing in asset. Volatility is an essential heartbeat for a trader because it moves the prices of the instrument up and down. When the volatility is low, the trader cannot make any profit or loss. When we have high volatility in the market, which happen during macroeconomic events, traders can occur slippage. Slippage refers to the difference between the expected price of trade and the price at which the trade is executed. This happens simply because at high impact events, a lot of traders pull their limit orders, so the order books get very thin. This is why your trade might not get filled because there is not a counterparty for it. The trading approach is the same as the trading strategy. It differs for every trader. Scalpers. This is probably the hardest one you can pick. Why? Scalpers are in out of the markets very quickly. Their trades last for minutes to sometimes just a few seconds. Because of that, you are required to focus 100% during the whole trading session. Scalpers also miss a lot of trading opportunities and rely solely on the big winner they are able to catch once in a while. This is something that can be very demanding on your psychology as you lose a lot and no one likes losing. So why do people choose to be scalpers if it is so hard? There are two major reasons for that. The first one is the returns. Being in and out of the market means that you are getting a lot of opportunities in the markets every day. Swing traders, for example, have to wait several days for the right opportunity, and they quite often just sit in their hands and wait. Scalpers do the exact opposite. Even though their win rate is usually lower, they can easily compensate it for it with RRR and number of opportunities they get. The second reason, which is not often talked about, is freedom. Scalpers and day traders, whom we are going to talk about next, don't really care about long-term movements in the market. Because of that, they trade during their currently active session, which can be 4, 8, or 10 hours long. Once they are done, they don't have to care about the market until their next trading session. This reduces the stress of babysitting any long-term position, which could disrupt your sleep and generally stress you out. Day traders are similar to scalpers, in a lot of things. They also watch markets in their predetermined session, but usually they want to watch the market the whole day. They are not interested in being in and out of the trades quickly, but they much rather capture a bigger intraday move. For that reason, they only open a handful of positions, yet sometimes they even stay flat for a whole day. Although day traders are required to watch the market for a longer period, the approach tends to be more relaxed, with high focus only required when the market trades around their desired level. Day traders usually hold trades for a few hours. As they try to capture the bigger move, they know that they have to give a market some room to breathe. They generally do not hold position overnight, but sometimes they do as they try to capture even bigger intra-week moves. Swing traders are looking to capture intra-week moves. They hold position for a couple of days, sometimes weeks. Swing trading is very popular among beginner traders, mostly because it doesn't require a lot of chart time and analysis. You can prepare for your trades in the morning, and thanks to alerts and limit orders, you let the market do its thing with very low input. This sounds like a piece of cake, right? Are there any downfalls? Yes, they are. Swing trading requires an extreme amount of patience, as you often have to wait for several days for the market to give you your desired setup. And the real work begins when you enter into position. Because you are holding the position for a longer time, you must be ready for swings in price and sometimes disrupted sleep. Also, since you are taking a lot fewer trades, it will take much longer to build your track record. Position traders. You will hardly become a position trader early in your trading career. Position traders are also called investors. They hold their trade for weeks, months, or years, and they usually follow large fundamental sentiments. A big amount of capital is required to become a position trader. A brokerage firm is a legal entity that provides its customer with access to the capital market, thus acting as a necessary third party for buying and selling securities. It facilitates secure transactions on behalf of its customer, who execute its own trades on his or her trading account. Forex broker is a company registered in the commercial register dealing with the mediation of access to trading on financial markets, especially in Forex. The broker company generates profits by charging spreads and trading commission. Forex broker provides its customer with the trading platform, which is software for access to financial markets, monitor current market events, issues, opinions, communicates ideas for trading in the form of comments, fundamental or technical analysis. When choosing a Forex broker, it is recommended to pay attention to market capitalization, company history, number of active clients, registration licenses, and security of finances. When you place a market order, you are going to get filled immediately at the best available price. One of the biggest problems with market orders is the risk of slippage during the high impact news, and also the fact that you are paying the spread all the time. This can be a costly decision, especially in highly liquid markets. The limit order, on the other hand, says that you only want to get in the market at one desired price and nothing else. Limit orders are considered a patient approach. Their disadvantage is in the fact that traders might get too patient and miss their desired fill. Stop loss and take profit are very straightforward. Stop loss get the trader out of the trade when it goes against him. Traders place stop losses at various technical levels or fixed point value. Using a stop loss prevents traders from unexpected spikes in price, which could result in significant losses. Take profit is the same order as stop loss, but on the opposite side. Take profit gets the trader out of the winning trade at predetermined price. Balance reflects your profit or loss from closed positions. Equity reflects the real-time calculation of your profit or loss. Equity considers both open and closed position. So, if you have a $5,000 trading account and currently have open one trade that is $500 in profit, your balance is $5,000, but your equity is $5,500. The risk-to-reward ratio is very simple. It is how much you are risking compared to how much you can gain. If you risk $100 to gain $300, your risk to reward ratio is 3 to 1. If you are risking $100 and you have a fixed $100 reward, you need to be right over 50% of the time to be profitable. With 2 to 1 risk to reward ratio, you only need to be right at 40% of the time to make money. The higher risk to reward ratio you have, the less percentage strike rate you need to be a profitable trader. The equity simulator on our website is a great tool you can use to show the expectancy of your trading based on strike rate and risk to reward ratio. Lot is a measurement that we use in Forex trading. One lot equals 100,000 units. So for example, if you buy one lot in euro-dollar, our investment is worth 100,000. If you are long one lot on euro-dollar, 1 pip equals $10 of price fluctuation. Because euro-dollar can move 50 to 100 pips a day, this can be a lot for traders with smaller accounts. Because of that, brokers allows opening position smaller than one lot. A namely mini lot, which is 10,000 units. A micro lot, which is 1,000 units. And nano lot, which is 100 units. Trading sessions. There are 3 major trading sessions in Forex trading: Asian, London, and New York sessions. All of these sessions provide an opportunity in the different markets as the volume is changing through the day. If you are trading in an Asian session, a pair like Euro, Great Britain Pound, it just doesn't make sense to do it. But looking at Australian dollar and Japanese yen should bring great trading opportunities. The London and New York sessions have the highest volume and where markets are moving across the world. Alright traders, if you have any question or you have not understood something or just interested in something, just let your comment down below. Don't forget to subscribe our YouTube channel, and thank you for your attention, and I wish you steady study and see you next time.